A very good morning, dear students. As we are in a new week, I wish that this week be filled with good thoughts, kind people, and happy moments. Welcome back to another class of accountancy. The chapter we are in is Recording of Transactions Part 1. Before we start our today's class, let's recall the topics that we have covered in our previous class. We have completed illustrating problems based on accounting equation. I hope you'll remember the accounting equation. Accounting equation indicates that assets is equal to liabilities plus capital. Capital is also known as owner's equity. Using the accounting equation, we have illustrated two sets of problems. The first two problems was related to table format, and one problem was related to the missing figures. The first two problems, that is the table format, the problem had set of transactions. These transactions were read from a business point of view. We had to identify the twofold effects, that is the giving and the taking aspect from a business point of view, and these items were considered to be recorded under their respective heads. And one problem was illustrated based on the missing figures, where we had to directly apply the accounting equation. In order to find out the assets, the accounting equation was liabilities plus capital. To find out liabilities, the accounting equation was assets minus capital. And to find out the capital, the accounting equation was assets minus liability. However, children, the most important thing when we are trying to illustrate problems based on accounting equation is that the accounting equation must be balanced. That is one of the most important thing that we have to remember. Let's begin our today's class. We are going to learn the most important and fundamental aspect of the subject, that is using debit and credit. In my previous classes, I have told you all there is lot to learn about debit and credit. And from today's class, we are going to learn the most important aspect, that is debit and credit. In accounting, the terms debit and credit indicate whether the transactions are to be recorded on the left hand side or on the right hand side of the account. If you could see, children, on the same slide towards the left hand side, I have given you all a picture of how an account looks. An account looks like the letter T. The left hand side is called the debit, often written as DR, and the right side is called credit, often written as CR. It's very important for you all to remember, children. The account that we are going to prepare in the subject will always be in a T format. The T format has two sides, left side, right side. Left side indicates debit, right side indicates credit. So therefore, to put it in short for you all, debit and credit in accounting is nothing but indicating which side the amount has been written. If the amount is entered on the left hand side, it is debited or debit. When we talk about credit, it is entering the amount on the right side of an account. So this is a basic thing that you have to remember. When I say debit, immediately remember the shape of the account. Left side is for debit. When I say credit, it is the right side of the account. When I told that we have to enter the amount on the debit side as well as on the credit side, that is the left hand side or on the right hand side, we have to follow certain rules. Basically, the rules of debit and credit. The rules of debit and credit has two approaches: traditional approach, modern approach. Traditional approach is also known as English approach. Modern approach is also known as American approach. Please note, children, these rules are fixed throughout the subject. When we say accountancy, we are going to start recording the transactions. When we say we have to remember the rules of debit and credit, these are the rules that has to come to your mind. These rules cannot be altered. They are basically very rigid by nature. It is fixed. So please remember, rules of debit and credit, it has two approaches: traditional approach, modern approach. Traditional is also known as English approach. Modern is also known as American approach, and these rules cannot be altered. They are fixed. Let me take you all to the first approach, which is traditional approach. The rules of debit and credit under traditional approach, which is otherwise known as English approach, it's been put into three types of accounts. Whenever I ask you all, traditional approach, what are the rules of debit and credit? Immediately remember these three accounts. What is it? Personal account, real account, nominal account. So these are the three types of accounts that will be reflecting under this approach. These accounts will also have the rules of debit and credit. Individually, we will be learning the rules of debit and credit. For personal account, you will have a set of rules of debit and credit. For real account, rules of debit and credit, and for the nominal account also you will be having the rules of debit and credit. The most important thing is you'll need to understand the meaning of personal account, real account and nominal account. So let us try to understand what is personal account. Personal account are those accounts which are related to persons with whom a concern carries on business. There are types of personal account. You have the natural personal account, artificial personal account and representative personal account. When I give you all the examples, children, you all will know exactly what is personal account. Okay, for now remember that personal account are those accounts that relates to a person with whom a concern is carrying out a business. When we talk about the types, the first one is natural personal account. That is the accounts of human beings. When I say human beings, it could be the owners, the employers, the employees. All these individual accounts of a person is what we call it as natural personal account. Example could be like Ram's account, Ganesh's account, Janaki's account, Sita's account, etc. That is, it's representing an human being's account. Okay. The second type is artificial personal account. Accounts of artificial or legal persons, that is, accounts of partnership firms, companies, clubs. You all are learning, right, in business studies, sole proprietorship, partnership. So when you are having accounts based off an organization, okay, we call that as artificial personal account. I'll give you all an example. Charles PU College account, National Schools account, Bharat Bank's account, then you have income tax department account. So these individual organizations or entities account is what we call it as artificial personal account. And the last one is representative personal account. This one we will be learning in depth in our next class. That is, representative personal accounts are those accounts related to prepaid expenses, outstanding expenses, etc. For now, all that you have to remember is when we talk about personal account, it is completely those accounts that represent or shows the account related to a person who actually carries on a business. Okay, it could be individual human beings or it can be the organization's account. Okay, so this is a basic meaning of personal account. Let us go to real account. What is real account? Real account are those accounts of properties, assets, things, liabilities. All these belong to real account. Initially, the most important was given to the assets, properties, and on a later stages they considered even liabilities and capitals to be as real accounts. And the last type is nominal account. Nominal account are those accounts related to expenses and losses that a business incurs and incomes and gains which a business earns in the course of a business. Okay, so let me put it in short for your children. Personal account are those accounts related to human beings, individuals, organizations, entities. Real account are those accounts related to assets. You all should know what is the meaning of asset by now. The economic resources. Liabilities. When we talk about liabilities, that is the amount that needs to be paid by the business to the outsiders. Okay. And then you had your capital. Capital also falls under the category of real account. And then you had the nominal account. Nominal account are those account which is related to expenses or losses incurred by the business and incomes and gains that a business earns. Now, having given you all the meaning of all these accounts, let us try to understand the rules of debit and credit under the respective accounts. Please remember, children, I am telling you all once again, the rules of debit and credit cannot be changed. Okay, so let us start with the first one. What is the first account? If you could look onto the slide, it is personal account. When I say personal account, remember the meaning. It is those types of account that completely relates to a person, organization, individuals, etc. So let us see what is the rule of debit and credit under personal account. Debit the receiver, credit the giver. What is it, children? Debit the receiver, credit the giver. The most important thing before I start explaining the rules of debit and credit, all that you'll have to remember is everything is read or understood from a business point of view. That is, keeping the business as an example is how you're going to read the transactions. I have explained it how we read the accounting equation. Okay, so when I say debit the receiver, that means whoever is receiving it, that person will be debited. Credit the giver is whoever is giving will be credited. Receiving aspect will be debited. Giving aspect will be credited. So please look on to the slide. The rule of debiting the receiver and crediting the giver comes into play with personal account. This rule is only for personal account. Please remember, children, debit the receiver, credit the giver. This rule is only for the personal account. We know what is personal account. A personal account is a general ledger account. When I say general ledger account, it's just an individual account pertaining to individuals or organizations. When I say organizations, you can remember it as entities. What are entities? Business. If you receive, when I say if you receive, it is if the business receives something, debit the account. If the business is giving something, credit the account. So wherever there is you, your account, all these symbolizes business. So if you receive something, it has to be debited. If you give something, it has to be credited. We have to implement these rules in a problem. That's when you will understand these rules of debit and credit. But for now, remember, personal account are those accounts related to individuals and entities. And the rule for personal account is debit the receiver, credit the giver. And these rules are completely from a business point of view. Please remember, children, when I say giving aspect, receiving aspect, only when the business is giving goods and services, it will be credited. And when the business is receiving goods and services, it will be debited. Okay, it's only from the business perspective. Okay, so we have completed with personal account rules of debit and credit. Let us go to the next account. Do you all remember the account? It is real account. The rules of debit and credit under real account. What is it? Debit what comes in and credit what goes out. What is real account? Real account is about assets, liabilities and capital. Correct? Now, asset might come in your business, it might go out of a business. Liability might come in a business or it might go out of the business. Capital also can come in a business and it might also be given out. So what happens? Debit what you're going to get. That is what is coming inside the business. Credit what is going out of the business. Look onto the slide, children. For real accounts, use the second golden rule. That is, a real account can be an asset account, a liability account or an equity account. Real accounts are also referred to as permanent accounts. Why permanent accounts? Because real accounts don't close at the year end. Instead, their balance are always carried over for the next accounting period. Now, for example, children, you'll have bought land, building, furniture, then you'll have taken a loan. Will it come to an end within a year? Absolutely no. It will be taken forward. Till you settle them, it will be there in your books of accounts. So what happens? That is why we say real account is also known as permanent account, because they are not closed within 1 year. Everybody knows what is accounting period. What is accounting period? 1 year. It could be from 1st January to 31st December or 1st April of the present year and 31st March of the next year. When we are preparing this accounting period, these assets, liabilities and capital will be with us. When I say it is with us, it's with the business. It is not at all closed. We don't sell off a building immediately in the next financial year. If you are settling off the loan, it will be shown in the books of accounts. But if we don't settle, it will be taken forward. Am I right, children? So that is why real accounts are those accounts related to assets, liabilities and capital. They are also known as permanent accounts. When we talk about the rules of debit and credit in a real account, when something comes into the business, example an asset, for example purchase of furniture. Okay, furniture account should be debited. When something goes out of business, credit the account. So what happens? We have seen for purchase of furniture. So furniture is coming inside the business. On the other hand, even cash is going outside the business. Do you all remember the accounting equation? Cash is also an asset. So what happens? Furniture account will be debited because it is coming inside the business. Cash will be credited because it is going out of the business. Okay, so under real account, what is the rule, children? Debit what comes in, credit what goes out. Okay, and you have to remember, when I say personal account, it is those accounts related to persons or individuals or entities, and therefore debit the receiver, credit the giver. When I talk about real account, it is completely those accounts related to assets, liabilities and capital. So there are chances that we might get an asset can come inside the business or go out of the business. Liabilities can arise in a business or go, decrease in a business. And on the other hand, capital can be given by the owner. It can also be taken by the owner as per his need. So what happens? We have to have the rules of debit and credit. So therefore, in real account, debit what comes in and credit was what goes out. Okay, so this we have completed the two accounts. What is the last type of account under English approach or traditional approach? It is the nominal account. Do you all remember the meaning of nominal account? Yes, we just came across. Nominal accounts are those accounts completely related to the expenses or losses that a business faces, and also the incomes and gains that a business faces. Am I right, children? You all have to remember the meanings of expenses, incomes. All this you will have to know. This and all we have done in our first chapter. Correct? So when I say nominal account, the first thing what should come in your mind is expenses and losses. Then what could be the rules of debit and credit? Debit, expenses and losses. Credit, incomes and gains. Very simple. It is not like how we had to get confused with the personal account and real account. Debit the receiver, credit the giver, debit what comes in, credit what goes out. This is so directly given to us. It is debit, expenses and losses, credit, incomes and gains. So the final golden rule of accounting deals with nominal account. A nominal account is an account that you close at the end of each accounting period, unlike your real account. I told you all, real account, it does not close during the accounting period, but here nominal account do close. Why? Whatever expenses is there, you have to settle it within the accounting period. If you have to pay rent, if you have to pay salary, you cannot take it forward for the next financial year. You have to settle it within that particular accounting period. So that's why we say it is closed at the end of the accounting period. Nominal accounts are also called as temporary accounts. Temporary or nominal accounts includes what, children? Revenue, expenses, gain and loss account. With nominal account, debit the account if your business has an expense or a loss. Credit the account if your business needs to record income or gain. Okay, so you have to debit all your expenses. When I say debit, you have to write all the expenses amount, losses amount on the left side of an account. When I say incomes and gains, it has to be credited. That means all the amounts related to incomes and gains will be written on the right side of the account. Okay, so we have completed the rules of debit and credit under traditional approach, otherwise known as English approach. So immediately when I say traditional approach, 3 accounts: personal account, real account, nominal account. Personal, debit the receiver, credit the giver. Then you have your real account, debit what comes in, credit what goes out. Nominal account, debit expenses and losses, credit incomes and gains. These are called the golden rules of accounting. The most fundamental rules, children. They are not at all altered. Throughout the subject, the same rules are followed. Okay, so the next slide that I will be showing you all, I've just put the same rules in a picture form for you all to understand it even more easier. Golden rules of accounting. You have personal account, real account, nominal account. Under personal account, debit the receiver, credit the giver. Under real account, debit what comes in, credit what goes out. Nominal account, debit expenses and losses, credit incomes and gains. Okay, so this is to do with the English approach. What was the next type of approach, children? Do you all remember the slide? The rules of debit and credit has two approaches. Traditional approach is what we have completed now. Let us go towards the modern approach. What is the other name for modern approach? American approach. This is one of the most simplest type of rules of debit and credit. Very easy to understand. Only if you all know the basic terms. If you all don't know the basic terminologies, it is very difficult to understand the modern approach. So for which you have to focus on 5 terms. Okay, the rules of debit and credit under modern approach, otherwise known as American approach, focuses on 5 aspects. You have to know the meaning of these 5 terms, children. If not, the rules will get confusing for you all. Okay, the 5 aspects are assets, liabilities, capital, expenses, revenues. We have read all this. Okay, so I have just given you all a simple meanings in the next slide so that you can remember these terms. Starting with assets. Assets are the economic resources owned by a business which have economic value that you can convert into cash. It's basically the most important economic resources which are very much needed in a business for its operation. What could be the examples of assets? Land, equipment, cash, vehicles. All these are the assets of the business. The next term is expenses. Expenses are the costs that occur during the business operation. Examples could be like wages, supplies. All these are the expenses examples. Liabilities. Amounts owed to the other person or business is what we call liabilities. That is basically the amount that a business has to pay to the outsider. Example could be like accounts payable, which is nothing but bills payable, loans, etc. Capital, which is otherwise known as equity. Your assets minus your liabilities is your capital. I've given you all the accounting equation, children. If not, what is capital, children? That is, capital is the initial amount invested or given by the owner. It can be in the form of an asset or a cash. Okay, so this is capital. Income and revenue, that is the the cash earned from sales. Any sales that has been made by the business, in return what we get, that is the money, the cash worth, that becomes the income or the revenue. I've just given you all a brief meaning. We have read this well advanced in our previous chapter. The first chapter we have completely given a deep detailed discussion on these topics. For now I've just given you all a brief thing. So when we talk about the rules of debit and credit under modern approach, the most importance are given to these 5 aspects: assets, expenses, liabilities, capitals and income. Let us try to understand the rules of debit and credit under all these 5 aspects. Please look onto the slide, children. The first one is capital. If the capital value decreases, it has to be debited. If the capital value increases, it has to be credited. This rule is applicable to all the owner's transaction. What could be the owner's transaction? Capital introduced, drawings. When all these transactions are taking place in a business, you might feel an increase or decrease in the capital. Correct? What is capital, children? The amount given by the owner. It could be the initial investment. Over a period of time, if required, the owner can give some more capital, which is called as additional capital. Then if he needs certain sum of money for his personal use, he can withdraw. When he is withdrawing the money for his personal use, from the business, it is called drawings. So what happens, there might be a difference in the capital value. Basically, an increase or decrease might happen. Please remember, when the value is decreasing, it has to be debited. When the value is increasing, it has to be credited. This is the first rule. Under what aspect, children? Capital. The next one is asset. Increase in asset is debited. Decrease in asset is credited. This rule is applicable to all the assets in the business. What are your assets, children? Cash, land, building, plant, machinery, fixtures, furnitures, trademarks, etc. All these are the assets, irrespective whether they are current asset, fixed asset, tangible, intangible. If they are asset, increase in asset means it should be debited. Decrease in asset means it should be credited. What do I mean by increase or decrease? For example, purchase of furniture. Now there is an increase in the asset value. Okay. Sold stock. There is a decrease in the asset value. So increase, it has to be debited. Decrease, it has to be credited. So we have completed the first two aspects. Let us go to the next one, that is liability. Decrease is debited. Increase is credited. Similar to your capital account. Can you all see, children? The same rules are there. Decrease debit, increase credit for capital. The same thing for liability. Decrease debit, increase credit. This rule is applicable for all the liabilities that takes place in the business. What could be the liabilities? Bank loan, creditors, short-term loans, etc. All these are your liabilities. What happens when you're suddenly raising funds to run your operations? Okay, to run your business operations, you need money. So you're borrowing it from a financial institution. There is an increase in the liability. After a certain period of time, as a business, you have to return that money to the person from whom you borrowed. So what happens? This is an increase in liability, so therefore it will be credited. Decrease in liability, it will be debited. Okay, so we have completed capital, assets and liability. Next one, expenses. Debit, increase. Credit, decrease. Okay, this rule is applicable to all the expenses in a business. What could be the expenses that a business faces? Paying rent, salary, wages, purchasing goods. All these are the expenses for the business. Am I right, children? What is expenses? The cost incurred. Okay, so what happens when you have to pay rent? There is an increase in expense. So what you will do? Debit the increased value. If you have you have paid the salary and you have reduced certain certain percentage of salary that you had to pay well in advance. So what happens? There is a decrease in expense. Correct? If the value decreases, initially the rent you would have paid 10,000. For the next month, maybe if you're paying 8,000. If there is any decrease in the value, it has to be credited. So expenses, debit, increase value, credit, decrease value. And the last one is income. Debit decreases, credit increases. This rule is applicable for all the incomes that a business receives. It could be like sales, commission received, interest received, etc. There are a lot when it comes to income. Okay, so what are the rules for debit and credit under income? Debit decrease, credit increase. So we have completed all the 5 aspects, children. I will give you also an easy method to remember these rules. Okay, if you could see, capital, liability and income, they have the same set of rules. Can you see the children? Capital, debit decrease, credit increase. Liability, debit decrease, credit increase. Income, debit decrease, credit increase. Don't you think all these are exactly the same? So you can club it together. When we talk about debit, debit decrease, credit increase, it is for three aspects: capital, liability and income. Similarly, if you see for assets and expenses, they have the same set of rules: debit increase, credit decrease for assets, debit increase, credit decrease for expenses. So you can club these two together. In order for you all to remember the rules, this is one of the easiest method to remember. Okay, so this is to do with the modern approach. Please remember children, traditional approach, three sets of account: personal account, real account, nominal account. Debit the receiver, credit the giver for personal account. Real account, what comes in debited, what goes out credited. Nominal account, debit all expenses and losses, credit all incomes and gains. This is to do with the traditional approach, otherwise known as English approach. Coming to your modern approach, also known as American approach, you have to focus on 5 aspects. You have the assets, liabilities, capitals, expenses and incomes. The rules for capital, liability and income are same, where debit decreases, credit increases. Assets and expenses will have the same set of rules of debit and credit, where debit increases, credit decreases. Very, very important for you all to know the meaning of these 5 terms in order to understand the rules of debit and credit. That's all for today's class, children. The most important and fundamental foundation, what is required for the subject, is what we have learnt now. All that you have to remember is how you have to implement these rules while illustrating the problems. Okay, so understand what is debit, what is credit, what are the rules based on different approaches. Any doubt, kindly get it clarified in the subject group. Thank you, children. God bless you all. Have a nice day.